For nearly 2 years, Wall Street had one simple trade: buy AI, Nvidia, Microsoft, Alphabet, Meta. Almost anything connected to artificial intelligence seemed unstoppable. Investors poured trillions of dollars into the sector, pushing technology stocks to historic highs and turning AI into the hottest investment theme on the planet. Then, in just a matter of days, billions of dollars vanished from the market. Stocks that had only gone up suddenly started moving in the opposite direction. And now investors are asking a question that would have sounded ridiculous just a few months ago. Was the AI boom overhyped from the start? Or is this simply another shakeout before the next leg higher? Because beneath the headlines, something much bigger is happening. Investors are no longer impressed by AI promises. They want proof, they want profits, and they want them now. In this video, we're breaking down what triggered the latest tech sell-off, why Micron's earnings became the center of attention, and whether this is the beginning of an AI bubble bursting or just another reality check before the next phase of the AI revolution. Let's get into it. The sell-off didn't happen because investors suddenly stopped believing in AI. It happened because expectations became almost impossible to satisfy. Over the past 2 years, technology companies have been spending at a pace we've rarely seen before. Massive data centers, millions of advanced AI chips, new networking infrastructure, new power capacity. The bill has already reached hundreds of billions of dollars. And Wall Street was happy to fund it because everyone expected AI revenues to explode. But here's the problem. The spending is happening today. The profits are taking longer to arrive. And that's making investors nervous. Think about it this way. For 2 years, the market has been pricing in a nearly perfect future. A future where AI transforms every industry, boosts productivity, and generates enormous profits for the companies leading the charge. Now, investors want evidence that future is actually showing up. That's why even companies reporting strong results can still see their stocks fall. When expectations get too high, good news stops being enough. You need extraordinary news. And lately, Wall Street hasn't been getting it. At the same time, many AI-related stocks were trading near record highs. Valuations became stretched, investor optimism became extreme. And when a trade becomes crowded, even small disappointments can trigger a sharp pullback. That's exactly what we've been seeing. But here's where the story gets interesting. The company that may have triggered Wall Street's anxiety wasn't Nvidia, it wasn't Microsoft, and it wasn't Alphabet. It was a memory chip company that most retail investors rarely talk about. Micron. At first glance, Micron may not seem as exciting as Nvidia. It doesn't dominate headlines. Its CEO isn't constantly making news, and most people don't associate the company directly with artificial intelligence. But right now, Micron may be one of the most important companies in the entire AI ecosystem. Here's why. AI models don't just need computing power. They need memory, a lot of it. Every advanced AI server relies on high bandwidth memory, often called HBM, to process massive amounts of data at incredible speeds. And Micron is one of the key suppliers helping make that possible. That's why investors were watching Micron's earnings so closely. The market wasn't just evaluating one company's results. It was searching for clues about the health of the entire AI supply chain. If Micron showed signs of weakening demand, investors would immediately begin questioning whether the AI spending boom is slowing down. But if demand remains strong, it would reinforce the argument that AI infrastructure growth is still very much alive. In other words, Micron's earnings weren't really about Micron. They were a stress test for the entire AI narrative. And that's why every investor on Wall Street was paying attention. But AI isn't the only force moving markets right now. The Federal Reserve remains one of the biggest factors investors have to deal with. For months, markets have been hoping for lower interest rates. Instead, policymakers continue signaling that rates could stay higher for longer. And that's a problem for high-growth technology stocks. Why? Because when interest rates remain elevated, future profits become less valuable in today's dollars. The higher the valuation, the greater the impact. That's one reason investors have become more selective. The era of buying anything with AI in the headline may be coming to an end. Now, Wall Street wants to know which companies can actually convert AI spending into sustainable earnings. At the same time, the US dollar remains historically strong. A stronger dollar makes American products and services more expensive for customers overseas. For global technology companies that can create additional pressure on revenue growth. And when growth expectations cool, stock prices often follow. So while AI remains the biggest story in technology, investors are now being forced to balance that excitement against a tougher economic environment. So is the AI bubble finally popping? Maybe. But calling this a full-blown collapse is probably premature. What's happening today looks less like the end of the AI boom and more like a reality check. History shows that every major technological revolution follows a similar pattern. Railroads, the internet, smartphones, first comes excitement, then speculation, then a painful reality check. And finally, the companies that truly changed the world emerged stronger than ever. The dot-com era was filled with businesses that had hype but no sustainable business model. Today's AI leaders are different. They're generating real revenue, serving real customers, and investing in real infrastructure. That doesn't mean their stocks can't fall. They absolutely can, and they probably will remain volatile. But there's a big difference between a bubble completely bursting and a market reassessing expectations. The easy money phase of the AI boom may be over. From this point forward, Wall Street will demand results. Not promises, not press releases, not flashy AI demos, results. The real question isn't whether AI will transform the economy. The real question is which companies will actually make money from it. And that's the question Wall Street is trying to answer right now. For long-term investors, periods like this often create opportunities when quality companies get dragged down by short-term fear. For short-term traders, volatility may remain the name of the game for the foreseeable future, because the next few quarters could determine whether AI becomes the most profitable technology revolution in decades, or whether expectations simply got too far ahead of reality. Now I want to hear from you. Are you buying the dip? Holding through the volatility? Or do you think the AI bubble is finally starting to crack? Let me know down in the comments. And if you enjoyed this breakdown, hit the like button, subscribe for more market analysis, and I'll see you in the next one.